Welcome to Finance Buzz Friday, your go-to for all the latest insights and updates from the financial services world. Today we're diving deep into some pretty hefty stuff. The Financial Reporting Council's new UK Corporate Governance Code for 2024, that is. This code, it takes effect on January 1, 2025 for premium listed companies. And it brings some pretty big changes, especially for all of us in the UK financial services sector. One of the biggest things people are talking about with this new code is the comply or explain approach. It gives companies a little flexibility, but they have to clearly justify any deviations from the code. But the real game changer, the part that's got everyone buzzing, is the focus on internal controls.
Yeah, you hit the nail on the head there. Section 4 of the code really shines a spotlight on this, especially with Provision 29. Now, it doesn't take effect until January 1, 2026, but it's already causing a lot of discussion. Think about it. Boards will actually have to declare the effectiveness of their material controls. As at the balance sheet date, this isn't just a quick check. This is a deep dive to demonstrate that all those checks and balances within a company were actually effective at the year end.
And for financial services, where even small slip-ups can have massive consequences, this is a pretty big deal, right?
Absolutely. Remember that rogue trader incident that rocked the financial world a few years back? That's a perfect example of what can happen when internal controls are weak. With this new code, the FRC is basically sending a clear message to UK financial institutions. You need to prove that you have robust systems in place to prevent those kinds of failures from happening.
So what does all of this actually mean for financial institutions? What kind of scramble are we likely to see in the coming months?
We'll think of it like reinforcing the foundation of a building. You need to make sure it's strong enough to withstand any kind of pressure. For financial institutions, this means they have to rigorously assess their existing control frameworks, identify vulnerabilities, and then put together a really solid action plan to address them. We might see anything from bolstering their risk management and internal audit functions to investing in new technologies and training programs. It's about creating a culture.
That sounds like a pretty big undertaking, and maybe even leads to increased costs in the short term.
Yeah, it could, but the cost of not doing it, that's a whole other story. Enhanced controls might mean some upfront investment, but they can help prevent much bigger financial losses later on. It's about proactive risk management instead of reactive damage control. And long term, it can actually build trust and confidence among investors, which will lead to a more stable financial system.
Speaking of investors, how do you think they will react to all of these changes? What kinds of questions will they be asking?
Well, investors are savvy. They want solid evidence that a company is managing its risks effectively. So expect questions like, how have you evaluated your risk management and internal control framework? What proof do you have to support your declaration of effectiveness? And how are you staying ahead of the curve when it comes to managing emerging risks, especially with all of the rapid technological advancements and ever-evolving regulations we're seeing?
Right. They won't just take a company's word for it. They'll want to see the receipts, so to speak. But let's take a closer look at the idea of material controls. How are companies even supposed to define what's material in their specific context?
That's a great question, and it's one that will probably spark a lot of debate in boardrooms across the country. The FRC says that materiality is company-specific. There isn't a one-size-fits-all approach. It depends on the company's size, business model, how complex its operations are, its risk profile, and even its strategic objectives. I mean, a small regional bank will probably have a different definition of material than a multinational investment bank. Makes sense, right? The risks they face and the potential impact of control failures are completely different.
Yeah, that makes sense. But this flexibility, while it's practical, seems like it could also open the door for subjective interpretation. What's to stop companies from downplaying certain risks if they decide they're immaterial, even if they maybe shouldn't?
You've got a point, and that's why the FRC is emphasizing the importance of clear documentation. Companies need to be able to justify their decisions about materiality, not just to themselves, but also to investors and regulators. They need to show a well-defined process for identifying and assessing risks, and that they used sound judgment in determining which controls are critical.
So it's all about transparency and accountability. Companies have some flexibility to tailor their approach, but they also need to be ready to back up their choices with solid reasoning. But what about the potential impact on the UK's standing in the global financial services landscape?
I think this new code could actually be a good thing. It could enhance the UK's reputation as a hub for well-regulated and responsible finance. It could even become a competitive advantage, attracting investment and top talent. If the UK can prove it has a strong and effective corporate governance framework, it becomes a more attractive destination for businesses and investors. You know what I mean?
Right, it's like a seal of approval.
Yeah.
Reassurance that UK companies are meeting a high standard of corporate governance. So in a way, this new code could actually boost the UK's competitiveness by demonstrating a commitment to good governance and transparency.
Exactly. It sends a powerful signal that the UK is serious about creating a financial system built on trust and accountability, where companies operate responsibly and investments are protected. This could really appeal to those who are looking for a stable and transparent financial environment.
But let's shift gears a bit. Let's talk about some of the other key revisions in this code. For example, there's a big emphasis on what the FRC calls outcomes-based reporting. Can you give us some more information on that? What does it mean? Why does it matter? Especially for financial services firms.
Outcomes-based reporting, it's about going beyond ticking boxes and proving how governance practices are actually leading to real value and contributing to a company's success over the long term. It's about showing impact, not just intention. Imagine a company that boasts about its amazing sustainability policies, but doesn't actually show how those policies are reducing its environmental impact. That's where outcomes-based reporting is so important. It forces companies to give real evidence of how their actions are creating positive outcomes.
So for financial institutions, would it be about showing how, for instance, their risk management practices are leading to fewer incidents of fraud, or how their customer protection policies are creating better results for customers?
Exactly. And for investors who are more and more interested in ESG factors, this type of reporting is hugely valuable. They can now assess whether a company is actually putting its money where its mouth is when it comes to sustainability, ethical practices, and long-term value creation.
It's all about substance over style then. But another change I noticed has to do with the streamlining of audit committee responsibilities. On the surface, it looks like a lighter workload. But you were saying that it actually puts indirect pressure on them to comply with the audit committee's and external audit minimum standard, even if they don't technically have to.
Right. It's kind of like a subtle nudge towards a higher standard. It's about pushing for better oversight and making sure that the people in charge of auditing a company's financial statements have the right expertise and independence. It might not be mandatory for all companies, but this nudge could encourage wider adoption of these best practices.
So it's setting a new standard for audit quality. But what about the strengthened malice and clawback provisions we talked about earlier? Some listeners might not be familiar with these terms. Can you explain what they are and why they're important, especially for the financial services industry?
Think of malice and clawback provisions, like tools that give companies more power to recover compensation from executives. If there's misconduct or poor performance, like let's say a CEO gets a huge bonus based on inflated earnings, and then it turns out that those earnings were fraudulent, the company could use clawback provisions to get some of that bonus back. It's about aligning the interests of executives with those of the shareholders, making sure that rewards are tied to real ethical performance.
So it's not just about punishing bad behavior then. It's also about encouraging responsible decision-making. And in an industry like financial services, where the consequences of misconduct can be so huge, these provisions are really crucial. They make sure that executives are held accountable for their actions.
Yeah, exactly. It's about rebuilding trust in the industry and making sure that executives are held to a high standard of ethical conduct. When you step back and look at all these changes together, from internal controls to outcomes-based reporting to these stronger clawback provisions, it's clear they're not just random tweaks. They all fit into a bigger picture.
Absolutely. They all show a renewed focus on improving corporate governance, encouraging long-term value creation, and in the end, building more resilient and trustworthy financial system. And that's good for everyone.
That's right. A stable and trustworthy financial system is good for everyone. It means a stronger economy, greater investor confidence, and ultimately a more prosperous future for the UK. It's not just about following the rules, though. Companies need to actually believe in this new code. It's about moving beyond just trying to comply and really committing to better governance practices, ones that support sustainable growth and responsible business conduct.
It's a challenge to companies, then, to prove they're not just saying these things, but actually doing them. But what about investors? They have a big influence on how companies behave, don't they?
For sure, investors, especially the ones focused on ESG factors, are speaking up more and more about demanding higher standards of corporate governance. They're really looking closely at what companies are doing, talking to boards, and using their votes to push for change. They have a lot of influence, especially as companies realize the link between good governance and getting investment.
So it's not just about avoiding problems with regulators. It's also about meeting the expectations of investors, who want companies that are not just profitable, but also doing things the right way, ethically, But companies and investors aren't the only ones involved, right? What about the regulators? How will they make sure companies follow this new code?
The FRC has been clear. They're not going to just sit around and wait for companies to tell them what they're doing. They said they'll use their enforcement powers to make companies answer for what they do. This could mean things like public reprimands and even financial penalties for serious breaches of the code. It shows they're serious about making real change.
It's about making things fair for everyone, so that companies who are doing things right aren't at a disadvantage compared to the ones cutting corners. But beyond companies and investors and regulators, I think the public has a role to play too, don't you?
Yeah.
We all benefit from a well-functioning financial system, and we should demand better from the institutions we rely on.
I agree completely. We can be informed consumers and investors. We can support companies that share our values, really look at the practices of the companies we work with, and hold them responsible. It's about all of us working together to demand a financial system that's not just about making money, but also one that's fair, ethical, and sustainable.
That's a good reminder. Corporate governance isn't just some abstract idea. It has real consequences for all of us. It affects our jobs, our investments, and how stable the economy is. This new code can only be successful if everyone works together towards a financial system that benefits everyone.
Well said. It's a process, not a one-time thing. This code is a big step in the right direction.
Thanks for joining us today. We've had a really informative conversation about the FRC's new UK Corporate Governance Code. I hope everyone listening now has a better idea of what these changes mean, why they matter, and how they can be a part of this important conversation. Until next time, stay informed, stay curious, and keep asking those tough questions.